Hello everyone. I hope you're doing good mentally and physically fit and fine. So, guys, we have covered now more than I think around 220 questions, and now we'll be doing more of them. Come on, let's try to finish off bank audit and NBFC in this particular session. Let's go, guys. So, the next question. So, next question is with respect to income recognition. Question is very simple, straightforward. There is no recovery for past 18 months in a particular account, not applied the NPA norms because it is guaranteed by the central government. Hence, these norms are not applicable. The bank has not invoked the guarantee. They have not asked for the money yet. Would your answer be different if the guarantee is by the state government? Not applied the NPA norms as well as income recognition norm to particular. Let's see, guys. So it's pretty simple, straightforward. So the concept is that you need to first specify uh, as per RBI clarifications. If there is a central government guarantee, then that particular account will not be classified as NPA, and no provision for NPA has to be made. But it doesn't protect the account for income recognition criteria. That means in case of NPA, we shift from accrual basis to cash basis. So here also we will shift from accrual basis to cash basis, and we'll book income on recovery basis only. If there's a recovery, that means cash basis only. So guys, it is pretty simple. We'll explain that as per RBI circulars. Definitely, if there's central government guarantee, there's a protection from NPA, no classification is required, no provision is required. But there is no protection in case of income recognition. In case of income recognition, we have to shift to the cash basis if the money is not recovered on regular basis. Same thing will get applicable to central government, this particular loan also. So protection from NPA classification provision, but no protection from cash basis of accounting in case of income. So in this particular case, because the recovery is not regular, definitely no provision for NPA, but the income recognition will shift to cash basis. We will reverse accrued income and shift to the cash basis. If there is a state government guarantee, there is no protection for NPA and no protection for revenue recognition. So if there is a state government guarantee, NPA will be recognized, provision will be made, and income recognition will shift from accrual basis to cash basis. So guys, this was there in the latest May 23 MTP. So simply explain two aspects. One is regarding NPA classification provision and the another is regarding income recognition. Then you explain from the central government point of view and then you explain from the state government point of view. Discuss the case and give the conclusion. Now, pretty simple, straightforward. Now, next is, again, there is a bank and the bank has recognized on accrual basis for dividends on securities and accrual basis for units of mutual funds. So they are following accrual basis for dividend on securities and dividend on units of mutual fund. And they are saying that dividend was declared after the end of the year. So again, guys, this question is on study material. Now let me tell you, these concepts are not covered in the main text. In the main text, in the main module, in main text main module. Okay. Let me tell you guys that this particular session is specifically for the students who are comfortable in English. For students who are comfortable in English, we have the session at 11 o'clock. At 11 o'clock, we have the session, and you can visit Audit Guru. You can visit Audit Guru Telegram channel. You can visit Audit Guru Telegram channel, and there you can get the IMP list. It is there. If you want to access these handwritten class notes, then you have to get registered for the batch, and then you need to go to course content, and there you need to go to course material, and you will get the access. Okay. Now, guys, let's see. So it's very pretty simple out here. Now we need to talk. We need to talk about income recognition principles. Income recognition principles in case of banks. Let's see one by one. So the most famous investment case of bank is bonds and debentures. Bonds and debentures. So for bonds and debentures, banks are supposed to follow accrual basis of income recognition. So as time goes on, we book income on accrual basis. Accrual basis, provided when it comes to these bonds and debentures, interest is received on regular basis, there is no default. Serviced on regular basis, there is no default. So we follow accrual basis. So it's pretty simple, guys. We follow accrual basis of accounting, that is time basis of income recognition, provided that we are receiving the interest on regular basis, there is no default. Okay, fine. Then next famous is those bonds and debentures instruments which are guaranteed by the government. So we have discussed this principle. Earlier also. If there is a central government guarantee, there is a protection from NPA, no provision for NPA. So it has to be made. On same lines, investments will not become NPI, non-performing investment, if there is central government guarantee. State government, guarantee of state government. Guarantee of state government is not going to matter a lot. But when it comes to income recognition, there is no protection. There is no protection. If you are getting interest on regular basis, that is, it is a performing asset, we follow accrual basis. If you are not getting income on regular basis, there is a default, then we shift to the cash basis of accounting as and when received, whether it is a central government guarantee or a state government guarantee. So whether it is central government guarantee or state government guarantee, we follow accrual basis of accounting in case of both, provided interest is received, there is no default on regular basis. If there is a default, we have to shift to cash basis. So basically, government guarantee is not going to have any impact on revenue recognition. Revenue recognition will be same as like others. No difference is going to make. Okay. Then we talk about dividend income. Dividend income on shares. Dividend income should be booked when right to receive dividend is established. And right to receive dividend is established when the dividend is declared. When dividend is declared, that time it is established, guys. So if dividend is declared in current year, income will be recognized in the current year. If dividend is declared next year, income will be recognized next year. When it comes to mutual fund, we follow cash basis of accounting. Yes, guys, it's pretty simple. Why we do so? Why such thing is done? Because value of the mutual fund units keeps increasing. Value of the mutual fund units keeps increasing So automatically all appreciations are accounted for. So don't book dividends separately. Don't book dividends separately. When you get cash for your dividend, that is the time you recognize it. So in case of dividend is a different instrument altogether. NAV is computed on daily basis. It is given on daily basis. If mutual fund earns anything, NAV keeps increasing and its effect comes automatically in our books of accounts. No need to book separately anything. Moment you get the cash, you need to book that cash as dividend income. Till that time, you don't need to do anything, guys. Okay, because it's a different instrument. It is accounted in different manner. So we book income on cash basis in case of mutual funds. Let's freeze, guys. The most popular debentures and bonds follow accrual basis, but if you're not getting income regularly, shift to cash basis. If there is a government guarantee, central government or state government, again follow accrual basis. If it is not received on regular basis, shift to cash basis. In case of dividend, book only when right to receive dividend is established, whichever is it. In case of mutual funds, because NAV concept is followed, you don't need to book it again on accrual basis or whenever you declare, you should book it when cash is received. Okay, when cash is received. Now, let's discuss the case. If dividend is declared next year, then income should be booked next year. And if mutual fund dividend is declared next year, that means cash will be received next year. Again, it should be booked next year. So, booking income in the current year is not correct. So, using accrual basis in case of dividend of shares and mutual fund is definitely not appropriate. It's not appropriate. Next year income should be booked for case of shares on right to receive, when right to receive dividend is established. In case of mutual fund, when cash is received. Okay, so in both the cases the accounting treatment is inappropriate. Beautiful cases, guys. It can come for 3 to 4 marks. 3 to 4 marks they can come. It is very simple, straightforward. You should have done it once. Now, audit of advances. Verification. So we are talking about how will you verify the advances, how the verification of advances will take place. It is there. Now listen, guys, whether you are performing statutory audit or you performing concurrent audit. Concurrent audit means simultaneous audit. If you're talking about audit of advances, overall audit procedures are going to remain same. No need to cram it separately. For a regular audit of advances and audit of advances for concurrent auditor, it will be on the same lines. For academic purpose, it is on almost same lines. No need to distinguish them. So remember one answer and write it at both the places. So BA.380 is the concept number we'll go to. Let's see, guys. So what audit procedures should be performed? This very As per latest module, these are the audit procedures they are talking about. Guys, there can be a lot of variation when it comes to audit of advances. This topic has been covered n number of times at different places, and people have expressed different points. Overall points are on the same lines. So as per latest module, this is the answer you should target. This is the answer you should focus on. So let's see, guys. First, we need to evaluate internal control systems, whether internal control systems are appropriate, and then we need to go for substantive audit procedures. They are not asking about internal control systems. They are asking about verification of advances. So we should directly go to verification of advances, that is substantive audit procedures. Okay. Substantive audit procedures. Let's see, guys. So to substantiate, we have two options: analytical procedure or test of details. Okay, guys, listen. If you want to perform audit of advances, first you need to perform test of controls. You need to check internal controls, whether all the important steps are there in internal controls, and then you need to go for substantive audit procedures. If they ask you, what will you check in internal controls, what thing should be there in internal controls, you'll go for what to check in internal control systems. If they're simply asking what will you verify in advances, you directly talk about the verification. And this is the latest answer as per latest module. Let's see, guys. So you'll talk about analytical procedures. Go and perform appropriate analytical procedures. So for advances, we can have a lot of audit procedures. We can compare with the previous year, understand what changes have happened in advances. There's drastic increase, decrease, or there's a consistency. It's the same thing is continued. The trend is continued. We can compare with the industry. What is the trend with respect to advances? Okay. So this can be done for these analytical procedures can be done for advances. Then we can do one more thing. We can do reverse calculation. If this is the interest we are getting on advances, we can do reverse calculation. What should be the amount of advances? So we can do comparison with the previous year, comparison with the others, and we can, with the help of interest, compute the value of advances, then match it with the actuals. We can compute expected advance and match with the actuals. Now, after analytical procedures, we shift to test of details. We can pick up few of the advances and then check where the loan amount, where the interest rate, the frequency is all correct as per the master data. Master data is the data which is used again and again. So for each loan, there is a master data where there is an amount of the loan, terms and conditions, interest rate, security, all the details are there. So go and check with respect to a particular advance whether it is in line with the master data. Then go and check whether all the loans given to a particular customer are grouped under a single customer ID, because we know that if one loan becomes NPA, all loans become NPA, and we want to understand what's happening with that particular customer, how many loans are given, what is the status of the loans, and whether money of one loan is used for repaying other loan. So we want to ensure that it is everything under one customer ID and we have the overview of what's happening with the particular borrower. So ensure you can use analytical procedures. You can use in substantive procedures, analytical procedures in test of details. First, go and check with the master data. Ensure everything is grouped in customer ID. Then ensure the interest is being charged regularly, properly. Now we are going to focus on specific types of accounts more. We are going to do these things, but for some of the account, all large advances, say all the advances above 50 crores. Just an example, depending on how big is the branch, large advances will be defined. For rest of the advances, we will pick up on sample basis. Examine account, identify into problem accounts. Then Then we'll try to focus on problem accounts. So the accounts where there are problems, there is no regular communication, or there is adverse communication, there is adverse news. So we are going to focus on the problem accounts. We are going to focus on problem accounts, that is SMA 1 and SMA 2. There's SMA 1 special mention account 1 and special mention account 2. We know that accounts become NPA. Accounts become NPA after 90 days. If they're overdue for more than 90 days. So SMA 1 and SMA 2 is, so accounts where amount is not recovered, where amount is overdue between 30 to 60 days is SMA 1, 60 to 90 days is SMA 2. So we want to focus on these accounts which may become NPA. Now, which are adversely commented upon by concurrent auditors, internal inspection, concurrent auditors, below them internal inspection team, RBI inspection team, concurrent auditor, internal inspection team. Focus on those accounts. Focus on accounts which are restructured. Restructures. Quick or early mortality. Accounts which have gone into NPA very quickly, within 12 months of the sanction. So, guys, we are going to focus on these accounts. Common sense, large advance accounts. For other sampling, problem account, that is SMA 1, SMA 2, adversely commented accounts, restructured accounts, quick early mortality accounts which slip into NPA within 12 months. So, in substantive audit procedures, first we are going to perform analytical procedures. In test of details, we are going to check accounts, loans through master data. We need to ensure aggregation in one customer ID and understand the whole story. We need to ensure that after a loan is given, interest is properly charged on them. We are going to focus on these accounts. Once loans are given, we are going to focus on periodic statements. We need to see whether borrowers are sending periodic statements as required by the agreement. If there are few accounts where the periodic statements are not received, we are going to focus on them a lot. Then we will focus on what latest financial statements, whether there are red flags in the latest financial statement, there are issues in the latest financial statement. So we are going to see whether periodic statements are received, latest financial statements are received. We are going to read latest audit report. Audit report in case of borrowers, what audit report is saying in its what auditor is saying in its report with respect to financial statements. Then sometime inspection of security is ordered. So what is coming out from those reports? So we are going to focus on these reports: regular periodic statements, regular financial statement, regular audit reports, regular inspection reports. So guys, if you want to verify advances, this is what you can write. And this, as I said, this is as per the latest module. And overall the points are on same lines, guys. Now, next they're talking about is revenue leakages. That's pretty simple. Now, this question has been asked in November 23 mock. They're talking about revenue leakages. Okay. So what is revenue leakages? It is pretty simple, straightforward. When bank is not charging interest properly, they are charging less interest. They are not charging interest. They are charging interest at less interest rate. There is a revenue leakage. They are not charging commission. That is revenue leakage. They are not charging transaction charges. That is revenue leakage. So sometimes auditors are appointed for revenue audit, and the main focus is to check whether there is revenue leakages. So there is a branch. Core banking system is implemented in that branch. Advance to the tune of 500 crores. The branch there are different types of loans which are given. Advances are there with the tune of 500 crores. A lot of different types of advances are given. There is CC, there is term loan, there is export credit facility, pre-shipment, post-shipment credits for the exporters. Then there's a letter of credit facility also given. Then fresh financing is done to new customers every month. Enhancements of the existing facilities also happening. As a result of above, the staff of the advances department is always on its toes. They're very busy all the time. The previous regular inspection of branch has pointed out huge revenue leakage. Previously, huge revenue leakage was pointed out. So zonal office is worried about it. What steps need to be performed to ensure there is no revenue leakage in advances? And so proper, discuss any five areas. Discuss any five areas in this regard. So basically, it's a huge branch with a lot of facilities. New customers are coming every month. Existing customers are enhancing their financing limits also. Last year there was huge revenue leakage. What will you check to check whether there are revenue leakages or not? Give any five. They have explained five things. See, the most important revenue for bank is interest. Interest, and the way interest is calculated, we have an amount, we charge interest rate, and then we have the period. If it is monthly or quarterly, it's monthly or quarterly. The way, as per terms and condition, interest is computed. One of the most important element is interest rate. So we need to check whether interest rate is appropriate. If interest rate is on the lower side, there is a huge revenue leakage. We need to focus on the interest rate, check whether it is as per sanction letter, and it is proper, it is matches with core banking system. We need to check whether the interest in sanction letter is the same interest is fed in the core banking system also, and calculation is done as per those interest rates only. So rate is proper and charged on all the performing accounts. First of all, the interest rate is proper, then it is charged to all of them, all the performing accounts. So we need to focus on the interest income, and for interest income, it's very important that rate should be proper. Frequency of computation should be proper, and it should be charged to the all accounts. Okay. Then renewal. So this is focusing on the interest income. Then verification of renewal charges in respect of existing customers enjoying CC and export credit facilities. See, these facilities need to be renewed every year. So renewal charges. Similarly, for fresh borrowers proposal, processing charges, including upfront fees for term loan, be verified in accordance with bank circular to ensure that all the charges are debited at time of release of facilities to the new customer. So moment a particular facility is sanctioned, same day we charge the processing fees and recur from the customer. These charges also need to be levied proportionately in respect of customer whose credit facility has been enhanced. So if there is an enhancement, again these charges will get applicable. So renewal charges, you need to talk about new customers, existing customers, and in that enhancement for all of them it should be charged. Then penal charges. If there is no proper submission of stock statement on due dates, if you are not fulfilling the loan agreement, then penal charges will be there. So whether penal charges are properly recovered or not on CC, on all the different CC limits, pre-shipment, wherever there was requirement to provide stock statements, other information. So penal charges. Then commission charge in case of letter of credit. Letter of credit. Then export bills. If you discount the export bills, again you charge commission charges. Export bills. Okay. Now, so I was thinking whether there is any shortcut. So instead of ly is li, reply. So you can remember, if they're talking about revenue leakage, we need to focus on different types of incomes which bank earn, whether all these incomes are properly booked or not. You talk about renewal charges on CC limits, export credit on renewal charges on regular basis, CC export credit facility. Okay, you're talking about the new customers, you're talking about existing customers and enhancements. Then export bill discounting, whether proper discount is charged, commission is charged, okay, proper processing fees and commission is charged. Then P is for penal charges. If the requirements are not fulfilled, documents are not submitted on regular basis, then letter of credit, proper commission is charged. And finally interest income, proper amount, proper rate, proper frequency, all the accounts are charged. So shortcut is reply. So if there is a revenue leakage, you should have proper reply. You should have proper reply. That can be shortcut, guys. Now, very good case they are discussing. November 22 mock paper. November 22 mock paper. You are part of engagement team conducting statutory audit of branch of Nationalized Bank. During the course of audit, it has come to notice that there are large number of CC accounts in branch. Many of the CC accounts are only partially utilized. So there are extraordinary large number of CC accounts. So that is unusual. Looking at the size of the branch, partially utilized during substantial part of the year. There is no proper utilization during the year. So again, it's a red flag. But in the month of March, the accounts are fully utilized. Again, that is quite unusual. On further scrutiny, it is observed that these account holders have made fixed deposit. They have made fixed deposit from the utilized amount. So they are withdrawing money from CC and they are making deposits. These deposits have been liquidated in the first week of April. Comment upon how this situation would be dealt by you as a statutory branch auditor. Statutory branch auditor, SBA. There is SCA, statutory central auditor, and statutory branch auditor. So it is pretty simple, guys. So we have a bank. So CC, they are taking a lot of money and they are using this money. So having large number of CC was a red flag, something unusual. Not utilized properly throughout the year, again quite unusual. In the month of March, suddenly loads of money is taken from borrower and they only become deposit and make deposits. So this is going on. Take money from bank only you can see that at one point of time you can see that the CC, loans are increasing. You can see that loans are increasing. On the other, loans are increasing. On the other hand, you can see that deposits are increasing. So in balance sheet, so when we talk about balance sheet, we can see that advances are increasing, and on liability side, deposits are also increasing. So both the things are increasing. As auditor, what do you think about it? And the most importantly, this is quite unusual, and everything is liquidated in the month of April. In the month of April, deposits are cancelled and loan is repaid. This is just done in the month of March. So guys, you discuss the whole case, and then you explain that this is a classic case of window dressing. This is a classic case of window dressing. This is a classic case of fraudulent window dressing, classic case of fraudulent financial reporting. Bank simply wants to show uh, a very good performance in their balance sheet, very good performance in their balance sheet, very good financial position in their balance sheet. They want to show that they have done a lot of hard work to increase advances. They have done a lot of hard work to increase deposits. They want to show a much better picture of a particular branch. So at one point of time, advances are increasing, at other point of time, deposits are increasing, and that too just for a month, for 31st of March year end. And after that, everything is again reducing. It's a clear case of manipulation, window dressing, fraudulent financial reporting, where advances are also jacked up and deposits are also jacked up. Simply explain the case first, and then you explain how this such fraudulent activity is happening. We'll ask bank to reverse this whole thing. We'll identify such CC accounts, such depositors, and ask them to reverse this, to cancel it out, to remove these fake things which are there in the balance sheet. If they agree, that's good, that's great. Otherwise, we'll modify our report. So that is quite interesting, guys. Quite interesting. We will also report in LAFR, long form audit report, where we talk about internal functioning of the branch, and we'll explain that how things are wrong, in CC, and how things are wrong in deposits. This is a classic. Many banks resort to it. So we need to talk about this. Beautiful question, lovely question, guys. Okay. Now you can get MCQs on this. And you can get statutory liquidity ratio. Guys. There can be MCQs. There can be small case studies on this. We know that all the banks have to maintain SLR. About 25%, whatever deposit they get, they have to maintain 25% of the deposit, as SLR with them in the form of gold, bullion, government securities, cash, and so on. They have to maintain 25% with them as a liquidity. So if anyone comes for ask for repayment of money, they should be able to do it easily. There should not be any liquidity problem anytime. Liquidity problem can be very dangerous. Guys, they can twist any particular point. Okay, guys, let's see. Let's talk about SLR first. So it's a very big answer, guys, very big answer, but I don't expect that they are going to ask that this complete thing in one go. They may target any part of this. And ask a small question. So first we will talk about SLR. We'll explain that whenever bank gets deposit, some part of it, some percentage of it, around 25%, need to be maintained with the bank in the form of liquid assets, in the form of gold, bullion, government securities and cash to maintain the liquidity, that is SLR requirement, that is SLR ratio. Fine. And it is required by law. It is required by law. As per Banking Regulation Act, banks are supposed to maintain SLR. The very interesting thing is that, auditors are supposed to verify compliance of SLR, whether banks are complying with SLR for 12 odd dates. Odd means different. It is not odd and even. 12 odd dates of different months. So auditors are supposed to check all the 12 months, and in that 12 months they have to target 12 odd dates. That means 12 different dates. So one date in each month will be there, and they will try to keep it different. And that particular date should not be a Friday. There was a MCQ on this, guys. That particular date should not be Friday, because banks work on fortnight basis. The banks work on fortnight basis, and their fortnight ends on second Friday. Fortnight starts from Saturday. It is well defined by RBI that they have well defined that this particular fortnight will start Saturday, and then first Friday is covered and the next Friday. So because things end on the fortnight, and for fortnight a lot of reporting is done, so they are saying don't focus on Fridays, don't focus on them, you focus on days which are other than Fridays. And then resultant report should be submitted to banks, top management and RBI. So very simple, you define what is SLR requirement, you define that it is required by Banking Regulation Act, and as per RBI circulars, we have to check the compliance of SLR for 12 odd dates, that is different dates in 12 different months, and they should not be a Friday. As I said, there was an MCQ on this, not should be a Friday, and then it should be reported to bank's top management. Then now further you explain how you do the checking for those 12 odd dates. How you do the checking for 12 odd dates, guys. So when it comes to audit procedures, whatever are the RBI requirements with respect to SLR, first we need to understand that. Then we will inform the bank these are the 12 odd dates for which we will be doing checking, and all the branches will be informed about it. Some of the branches majority of the branches are going to have branch auditor. They will be informed that listen, these are the 12 dates for which we are going to check SLR requirements. So ensure that for these 12 odd dates, trial balance which shows deposits, trial balance which clearly shows the deposit levels for this 12 odd dates are generated, and they are verified and they are checked, and then you are sending it to headquarters. So branch auditors will be given instruction for this 12 odd dates. You check corresponding trial balances, ensure that deposits are shown, and it is sent to head office. Also verify the correctness of the liquid asset at the branches. For unaudited branches, head office auditor will check on its own whether the trial balance looks appropriate. Now what will happen? For this 12 odd dates, you are going to get trial balance from all the branches. You are having trial balance of the head office and then all the branches, and that all the trial balances will be consolidated. So we'll check whether bank has properly consolidated trial balance for all the 12 odd dates. Well, trial balance are properly consolidated. We will test on test basis the consolidation regarding detailed position prepared with reference to returns received. We will test whether all the branches are covered, whether proper amounts are taken. DTL is demand and time liabilities, that is nothing but deposits. Savings deposit is demand deposit, it can be withdrawn any point of time. They are demand and time liabilities. Demand deposits means savings, Time liabilities means fixed deposits. So check whether all the branches are covered, whatever data is covered, it is proper as per the returns received from branches. If it is audited branch, great. You see what branch auditor is saying, whether trial balances are appropriate. If it is unaudited, you perform some preliminary checking whether it looks appropriate. Check overall consolidation. Listen guys, we want demand and time liabilities for these 12 odd dates. We need this for 12 odd dates. Then once we know DTL balance, demand and time liabilities for these 12 odd dates, we'll apply 25%. We will understand what should be the level of assets for this 12 odd dates, and we'll compare it whether that much assets are maintained or not. Now here we talk about this very important. Again, it was targeted in MCQs. This can be targeted in case studies also. That when you compute DTL, something should be excluded. What should be excluded? Okay, RIL, just a joke guys, don't take it seriously. RIL, Reliance Industries, should be excluded. Okay, RIL Industries should be excluded as per PM. There is a shortcut. RIL should be excluded as per PM. Now R stand for, listen guys, now those accounts where you see a liability, where you see those accounts where you see a credit balance, but then you know that this is not in nature of DTL, demand or time liability, it should be excluded. So if there is a recovery from the borrower which was already considered bad and doubtful, if there is a recovery from a borrower which was considered bad, doubtful, it was written off, if you have recovered the money, accounting entry is cash bank account debit to recovery account credit. Now this credit balance, this is not supposed to be given back. It is not in nature of DTL. So such kind of recovery balances should be excluded. It should be excluded. Then I stand for Indian currency. So I stand for Indian currency. Okay. Now what is that Indian currency? Suppose you have made payment of $1 lakh for your customer. You have a customer who is an importer. You have made payment of $1 lakh. Now customer has deposited money 1 lakh into 80 rupees. Suppose 80 lakh rupees he has deposited. So accounting entry is cash account debit to cash bank account debit to a particular account, money to particular amount, money received for import bill credit. Now this credit balance is appearing. Basically this credit balance and the credit and debit should get knocked off. When we made payment, a debit account was created. When we received money, credit account is created. Basically they should be adjusted, but because the rate which should be used, it is not yet finalized. That's why this account is, the credit balance account is appearing. It is a temporary stage. It will be soon knocked off. So this credit balance should not be taken in DTL. So if there is a credit balance of recovery, it should not be taken in DTL. If there is a credit balance account because of Indian currency received and it's a temporary account, it will be soon knocked off. It should not be taken in DTL. Link branches. So what are link branches? So link branches are branches who are supposed to deal with RBI. Supposed to deal with RBI and other banks. Are supposed to deal with RBI and other banks. Okay. So in a particular region, there can be 20-30 branches, but only one branch is responsible to deal with RBI, other branches and corporates. If money is received by such branch, they are not yet used or adjusted. Listen, what happens? So banks have, in different regions, they have link branches. Okay. Now link branches receive a lot of money. Suppose they got money from corporate, from Reliance itself. So Reliance has announced a dividend, and suppose dividend is 5,000 crore. Suppose dividend is 5,000 crores. So accounting entry is cash bank account debit to RL dividend payable 5,000 crores. Reliance will give checks across the nation that you withdraw this money now. Now these checks will be deposited across the nation. Suppose the HDFC Bank, and money will be paid from across the branches in the nation for this dividend. Now what is happening? Listen guys, in link branch you can see a credit balance about Reliance dividend payable, and in other branches you can see debit balance that we have paid the dividend, now it is recoverable. So basically credit balance in link branch and debit balance in other branches need to be knocked off. This knockoff is not yet done. So the credit balance which is appearing in link branch it is a temporary balance. So again it should not be included in DTL. Then paid up capital, reserve, P&L credit balance, these are not in nature of DTL. Amount of loan taken from RBI, from Exim Bank, NHB, SIDB, NABARD, this is not in nature of DTL. These are credit balances, but it is not in nature of DTL. It should not be taken. Margins held and kept in sundry deposits. Many times before giving loan, we call for margin money. We call for margin. First prove that you have 5 crore rupees, then we'll give you loan of 15 crore rupees. So margin money is taken. This margin money is again not nature of regular DTL. It should not be included there. Guys, you may get a problem. You may get a complete problem that as per consolidation of trial balance, this is the total amount of DTL. And then they will say that it is including recoveries. It is including Indian currency credit balance. It is including credit balance of link branch. It is including paid up capital, reserves, P&L balances or borrowings. It is including margin money. And you will say that no. They are not in nature of DTL. They are not in nature of DTL. They should be excluded. All these 5 things should be excluded. Okay, so you should read carefully. If they write it is there included, then you exclude it. If they say that it's already excluded, we don't need to do anything. We need to ensure they're excluded. Okay. If they are not, we will do it. If it's already done, no need to do it. Read it carefully, you will understand what should be done. Then there are certain balances which should be included. Okay, new CBI order includes many things. Nostro account. So when foreign banks come to India, that is Vostro. Okay, they are coming, Vostro. And then we are going there, we are putting our nose in their countries. If we are going to foreign countries and opening foreign currency balances, it's called Nostro account. So it's very simple. Suppose we have opened Nostro account. We have opened Nostro accounts, and in these Nostro accounts, you have received a lot of deposits from the customers, foreign currency deposits, inward remittances, and they are not yet accounted in the Indian books. It should be included. If you have received a lot of deposits in foreign currency in Nostro accounts, it is in the nature of DTL. It should be accounted for. It should be included in DTL. Net credit balance in branch adjustment account. Inter-branch account may have net debit balance or it may have net credit balance. If it is having net credit balance, this amount has to be paid to people. This amount is payable to people. It is in nature of DTL. It should be included. So Nostro accounts. So if there are deposits in Nostro account, it should be included. If there is a net credit balance, it is payable. It should be included. All these amounts are payable to customers. It should be included. Borrowings from abroad banks. Listen, this is very interesting. If there is a borrowing from abroad banks, this amount is payable to outside Indian banking system. It should be included. But if you take borrowing from the Indian banks, it is not included because it is payable to Indian banking system. It is within Indian banking system. So RBI says that if you've taken money from outside the Indian banking system, it is payable outside Indian banking system. Something is payable within banking system, it is not included in DTL. So when you are supposed to pay to other bank, it is not included in DTL. It is payable outside, it should be included. If there is an interest accrued again it is payable, it should be included. So guys, new CBI order, 4 things. Nostro account deposit should be taken, net credit balance of branches should be taken, borrowing should be taken, interest should be taken. So guys, as I said, you will get a simple case study. Already MCQ has been asked on this. They will give detailed balance. They will say that these amounts are there. Okay, then you remember, oh, this should be excluded, minus, minus, minus. Oh, this should be included, plus, plus, plus. Okay, and you have to carefully see whether it already included or not, whether it is already excluded or not before you make any adjustment. Because something is already there, you don't need to do anything about it. So with this, you will get for 12 odd dates. For 12 odd dates, you will get proper 12 balances. You apply 25%, you will come to know what should be the, what you will come to know. You will come to know what we will come to know what should be the how much liquid asset should be maintained. Now you go and see value of the gold, how much cash is there, value of the gold, value of the securities, and see whether it is properly maintained or not. Special focus to unaudited branches if they are big enough. Nowadays banks use ADF, automated data flow system, for SLR reporting. So you can confirm a lot of data from ADF system also. So guys, first explain what is SLR, then you explain the requirement is there, then you explain the concept of 12 odd dates, then not being Fridays, then you explain what should be, then you explain that how everyone is informed, how all the data come from audited and unaudited branches, how consolidation happens, how it is checked. Then you explain what is excluded, Reliance, okay, Reliance should be excluded. This is what PM says. And what should be included. New CBI order should be included. You will get the proper balance, and then you check whether SLR requirement is fulfilled or not. Guys, they very high chances that they ask a question on this. Very high chances that they ask question on these things, guys. So it covers case studies also. This covers MCQs also. Then next is scope of concurrent audit. Scope of concurrent audit. Scope of concurrent of bank with reference to RBI guidelines. With reference to RBI guidelines. Scope of concurrent audit. Just a minute, guys. Now 760, it should be, guys, BA dot 760. Let's understand this, guys. Now, what is scope of concurrent audit? What is scope of concurrent audit? It's very simple, straightforward. So first thing you are supposed to explain who will decide. Scope means what you are going to check and how you are going to check. Scope is what you are going to check and how you are going to check. That is called as scope. That is called as scope. So question is, who decide the scope of concurrent audit? So scope is determined by inspection and audit department. Bank's inspection and audit department, they are going to decide what should the scope of concurrent auditor, what they're supposed to check and how they're supposed to check. But they are going to take consultation advisory from ACB, Audit Committee of Board of Directors. Audit Committee of Board of Directors. So first you're supposed to tell who decides the scope. So Department of the Bank, Inspection and Audit Department decide the scope, and they take the consultation of ACB. So when decide the scope, what they generally do, they cover all the high risk transaction. So all the high risk transactions will be covered. So high risk, they will ensure that wherever across the bank, in all the branches, everywhere, wherever high risk transactions are done, they should be covered. For example, huge foreign currency transactions are there, they should be covered. Huge loans are there, they should be covered. Huge deposits are there, they should be covered. All the high risk huge transactions should be covered. Investment decisions are the investment transactions that they should be covered. There are RBI guidelines which tell how the scope should be decided for the concurrent auditors. And so there's a shortcut out here. Generally these areas are covered. Cover A to I, A, B, C, D, E, F, G, H, I, except B, E, G, big. Okay. A stand for cover advances, drop B. C for cash, D for deposit, drop E. F for foreign exchange transaction, drop G. H for housekeeping. Housekeeping means maintenance of all the records and forms. That is housekeeping, not cleaning. Then I stand for investment. Generally these things are covered in the scope. So it's very simple, guys. You decide, you explain what do you mean by scope, you explain who decides the scope, whose consultation is there, generally what kind of transactions are covered, what RBI says about it, and RBI gives instruction that these are the general areas which should be covered in the scope of concurrent audit. Concurrent audit is simultaneous audit, regular basis audit, which is generally conducted on monthly basis. Now, what comes in contingent liability? What comes in contingent liability? BA.620. So question is very simple. While auditing Apna Bank, you observe that lump sum amount has been disclosed as lump sum amount has been disclosed as contingent liability. No, we need a breakup. We need category wise breakup. Okay, it is required by format. It is required by format given by banking regulation. So a lump sum amount disclosure is definitely not at all acceptable. Not at all acceptable. So in content, as per third schedule of Banking Regulation Act, in footnote, you are supposed to give content liability. Now, how we try to remember, the most famous content liability for bank is guarantees. Guarantees given on behalf of constituents, that means guarantee given on behalf of customers. Guarantee given on behalf of customers. So first show that too in India and outside India. Then apart from that, so that is a content liability for the bank. Apart from that, they accept a lot of bill acceptances, endorsements, obligation. They accept bills, they issue letter of credits, they issue letter of credits to outside parties. Okay, that will also become content liability. Apart from that, if they have invested in partly paid, if they are partly paid investment, anytime a call is done, they will have to pay for it. Now, this is a very old format and it is including content liability. I know that in Schedule 3 and as per Ind AS, nowadays this is called commitment. But is an old format, it is still in the content liability. Then foreign exchange contract, money need to be payable, may need to be payable, that is content liability. Then claims which are not acknowledged as debt is a content liability. Any other items, then there's a bills for collection, is a separate thing. So in footnote, you need to give content liability, the famous one, guarantees given on behalf of customers to different parties. That's a content liability in India, outside India. Acceptance, endorsement, obligation, AEOs, letter of credits we issue, that will come here. Endorse, we, lot of bill exchange we endorse, that will come here. Partly paid investments, so famous being content liability, then below that AEO, then below that your partly paid investment, below that liability under foreign exchange contracts, below that claims. So it's in a sequence. We have arranged in a sequence from most popular to the least popular and then other items. So whatever the contention these guys are making is not appropriate. Lump sum amount should not be disclosed. There should be a proper breakup. See, we have deleted questions of six exams that we very least expected. So we have deleted questions of 6 exam, guys. Now here we talk about credit appraisals and credit monitoring. So it's a unique question. Again, they are not focusing on the main. When we talk to main theory, when we talk about main theory, it is not there in the main theory, guys. It is not there in the main theory. We talk about credit appraisals and credit monitoring. There's an engagement partner, they're doing statutory audit, and they're doing statutory audits. Now, they want to ensure that there are good internal control systems. They want to check internal control system to prevent and reduce the risk of loss, risk of loan assets becoming NPA. So there should be good internal control system. There should be very careful credit appraisal, credit worthiness. Loan should be given to proper borrowers after a lot of checking, so that there are less chances that things become NPA and there's a default of loan. Further, there should be continuous credit monitoring so that there is a early detection and steps for the NPA. Okay, so when initially when we are going the loan, there should be good credit appraisal. After giving the loan, there should be good credit monitoring so that there is early detection of the NPA and proper steps are taken to ensure that loan doesn't go into NPA, and if it falls, the proper steps are taken to bring it out of the NPA. So what kind of controls banks should have in the areas of credit appraisal? What kind of controls banks should have? What kind of steps and procedures banks should have in the area of initial credit appraisal and letter of credit monitoring to ensure that proper loans are given and to ensure that there is early detection of NPA? So they are talking about 4 things. They are asking about 4 specific controls. They're asking 4 specific controls. So first is third party data. So whenever loan applications come to you, study it, analyze it, always try to use more and more third party data. If you're simply using the data which is given by the borrower, data from the borrower can be manipulated, it can be biased, it may not be true. So we should try to use more and more data from the third party sources. Okay, third party sources, that will be very, very important. So what credit rating agencies are saying about them? Okay, we need to see that what credit rating agencies are saying. Then what, suppose it's a listed company, what equity research reports are saying about them. We should take third party sources so that we better understand this client, we understand what kind of risks are there, and we ensure that we are giving loan to proper people after a lot of analysis. So use more and more third party data sources, as I said, like using credit data from the credit rating agencies, using data from the industry records, industry portals, industry records. That can be very useful thing, or data which is coming from the other banks, that can be very, very useful thing. Then focus on the concept of SMA. SMA is a special mention account. So where overdue amount is between 30 to 60 days. Okay, more than 30 up to 60 days, that is SMA 1, and more than 60 up to 90 days, that is SMA 2. Now focus on these SMA accounts. Keep analyzing these SMA accounts because they can become NPA. They can become NPA. So focus on NPA accounts, get in touch with the client, tell them what's happening, ask what's the problem, help them, guide them so that they don't go into NPA. And if they go into NPA, there's an early recognition. Remedial actions can be taken early if they focus on SMA. Then there should be automated early warning system in banks. Early warning system. So there should be softwares where a lot of criteria are fed, that if no payment is received continuously for suppose suddenly there's a big gap in credits, no money is deposited. So algorithm should be there that these guys used to deposit money every week. Now it is more than 4 weeks money has not received. There's an early warning system. So suddenly credits have dried up, or the average money they deposit have suddenly gone down, or the average withdrawals they do has suddenly gone up, or the outstanding amount has suddenly gone up. There should be early warning system so that we can identify NPA quickly. We should also focus on repayment behavior. So credit information companies are there which give CIBIL. Go and look at the CIBIL on continuous basis at the initially and go and understand the repayment behavior, how their repayment behavior have been there in the past and how it is going on right now. It will be very useful information, guys. So if banks focus on these 4 things: third party data, SMAs, early warning systems, and repayment behavior. Three. Okay. So if they focus on three, it will be really good. It will be really good for uh, credit appraisal, and then credit monitoring. S is for SMA, focusing on SMA accounts, special mention accounts. Special mention accounts, that means which are overdue more than from 30 to 60 days and 60 to 90 days. Focus more on them. There will be early detection of NPA and good remedial actions. Then third party data, while credit appraisal and monitoring, that can be good source of information for both. Then repayment behavior from the CIBIL companies, credit information company, again good data. And then have early warning systems. Incorporate all the unusual things which can happen, and there's an early warning system. November 23, this was asked. So what they have done is they have given, these are different banks. The different banks, gross NPA. So gross NPA means this amount of loans which have become NPA. Total amount of loans which have become NPA. Net NPA means when you reduce provision for NPA, you will get net NPA. Now, ratio of net NPAs to net advances. What is the net NPAs and what is the net advances? That ratio. If you see that the lowest is BBI Bank and highest 3.97 is your KNO Bank. Highest is KNO Bank, about 4%. That is huge. Generally, this ratio is an indicator how well bank is handling their NPAs. So you need to explain what do you mean by gross NPA. This is the amount of loans which have become NPA. It's gross amount without any deduction. When you deduct the NPA, so first explain. They're asking what is gross NPA and what is net NPA. Then, as auditor of KNO Bank, they're focusing on KNO Bank. What inference would you draw when you compare ratio of net assets to net advances? So you explain first what is gross NPA. You explain then you analyze that if you are an auditor of KNO Bank, you can clearly see that the ratio is quite high as compared to other banks. The NPA ratio is quite on a higher side. there is the huge NPA. This clearly indicates a lot of things. Their credit appraisal is not that great. These credit appraisals are not great. They have aggressively given loan to inappropriate parties. Systems were not great. Loan making system, they are very aggressive loans they have given, and now it has backfired. Further, because of huge amount of NPA, there's a big problem. It may indicate that there are more undetected NPA or provision for NPAs in the lower side. It may be a tip of the iceberg. Maybe there are more NPAs. Maybe more provisioning is required. So we need to be very, very careful while checking NPA and provision of NPA of KNO Bank. It is a high risk area. In fact, it is a significant risk area. So that is the indicator we are getting, that NPAs in these banks are altogether different from all other banks. So that those are the conclusions we are supposed to focus on. Those are the things we are supposed to talk about. Very interesting, guys. Again, it has not been asked in exams. Very high chances that it is targeted in exams. Stock audit issues, study material 23 question, guys. So it's very simple. A chartered account goes for stock audit issues, check a lot of things, and after stock audit, the auditor says everything is fine, everything is good enough, everything is proper, stock is proper, debtor is proper, drawing power is proper, no problem, no issues at all. And after a week, it is identified that there are 5,000 bags of rice valued 1.5 crores. There is a fungus. So basically, stock is there, and that stock is having fungus. That stock is bad. That is a bad stock. It is a useless stock, and it was there for 15 months. So what you infer from it, that professional was not diligent. Person goes for stock audit. So you explain the concept of stock audit, that banks appoint chartered accountant firms to go and check current assets of the borrower wherever there is a huge working capital limit, CC limits, and current assets are given as security. They are supposed to go and focus on the stock, debtors, creditors, and overall financial health. Now, there was a stock which was unsold for 15 months. That is a huge time. It was a slow moving item, in fact no moving item. That should have been checked carefully by the auditor. In fact, the condition of the inventory should have been checked, but auditor didn't even open the bags, didn't see the actual condition of the stock, and that's why such a big issue was left out. It was ignored. That means chartered accountant is not working diligently, carefully. Okay, not working carefully, diligently. Verification of stock, the condition has not been done properly. All the 3 points say the same thing. So we need to, I think you should first explain the concept of stock audit. You need to first explain the concept of stock audit. They need to explain that people should go and focus more on quality of stock, quality of debtors, amount of creditors. We are supposed to focus on that, and we should be very careful. It's a sensitive matter. Then you come to the problem. Now, such a big thing has happened. That means not properly planned and executed. Condition of the inventory is not seen, which should have been there. It will have a huge impact on drawing power calculation. It is not performed carefully, carelessly, just without seeing the actual things, ground realities. Things have been conducted. So, guys, we are through with bank audit. A lot of questions were covered. A lot of interesting questions were covered, guys. Okay, let's see, guys. Let's go to NBFC now. When we talk about NBFC, guys, so identification of NBFC, there is a Satyam Private Limited engaged in trading activity. It has made investment in shares of other companies and advanced loans to the group companies amounting to more than 50% of the total assets. However, trading income constitutes majority of total income. Majority of total income. Whether the company is an NBFC. So, for a company to become NBFC, where particular company is an NBFC, first we need to see nature of transactions. First we need to see nature of transactions, whether they're into any kind of financing activity, whether they're using their money, they're giving their money to others to do business, others, okay, whether they're in any kind of financing activities. If there's any kind of financing activity, the next is you need to see 50-50 rule. You need to see pattern of income. You need to see pattern of income and pattern of income and pattern of assets. If more than 50% of the income is financial in nature and more than 50% of the asset is financial in nature, okay, more than 50% of the assets, total assets, and more than 50% of total assets excluding intangible asset, and more than 50% of gross income if it's financial in nature, then we say that their major business is finance. There is major business finance. It will be termed as NBFC. So first you need to explain that we need to focus on nature of transaction, whether any finance transactions are there. We need to see the pattern of incomes and assets, 50-50 rule. Then you discuss the case. And then you give conclusion. Okay. So here case discussion that then trading activity, major lot of financing activity is done, but then majority income is still from the trading activity. As majority of the income, both the conditions should be satisfied. Here, as majority of the income is coming from the trading activity, it is definitely not an NBFC. It is definitely not an NBFC. This is a very, very famous concept. This is a very famous concept on how to identify a NBFC. And it is going to be repeated again and again. Krishna Private Limited is primarily into business of selling computers, selling computer parts. However, the company is fulfilling the principal business criteria as at balance sheet date. Financial assets are more than 50% total assets, and financial income is more than 50% gross income. What should be the obligation? What should be the obligation? What should the obligation of statutory auditor in such scenario? Again, you explain that we should see the nature of the transaction which are happening in a company, whether any financing activities involved. If yes, then you go and see the pattern of incomes and assets, apply the 50-50 rule, more than 50% income, more than 50% expense, you talk about that. Okay. Then you discuss the case, and conclude definitely this particular Krishna Private Limited is fulfilling 50-50 criteria. It is a NBFC. It is a NBFC, guys. So if it is a NBFC, they need to ensure that they are having, they need to ensure that they need to go to RBI and then get them themselves registered. They will need certificate of registration. It is a NBFC. You are going to need certificate of registration. Okay. Next, you are supposed to maintain at least net own fund of 2 crore rupees. All the NBFCs are supposed to have net own funds of 2 crore rupees. Some NBFCs are even required to have higher amount of net own funds. Okay. So again, you talk about nature of transaction. You talk about 50-50 rule. 50-50 rule. You discuss the case. There is a conclusion. But then here they are further asking obligations. They are further asking about obligation. What need to be done, not need to be done. So there is obligation to have certificate of registration from RBI. There is obligation to maintain net own funds of 2 crores. And then they have not specified anything. That means we can easily assume there is a default. We can easily assume that, guys, there is a default. And if there is a default, we'll discuss about this later, that in case of NBFC, we have to make report on the financial statements. Along with that, we have to make one more report for board of directors. And there are separate directions for it. And if there is any adverse in reporting to board of directors, then all the adverse points should be collected and reported to RBI, and that's called exception report. Now in this particular company, not taking certificate of registration is a big issue. Not maintaining net own funds is a big issue. So there is a big default. So exception report will be prepared about the default and it will be sent to RBI. Guys, no need to remember these things. No need to remember. It's simply, they are simply saying that if there are default of these things, they're giving list. If there is a default of these things, then we need to do reporting to RBI. We don't need to remember that list. So explain these things, that it's a NBFC. They're not fulfilling things. So we need to report it to RBI about it in exception report. That will be fine. Further additional knowledge in Caro report also. In Caro report also you specify that is NBFC and they are not taking certificate of registration. Many such cases are there across India that suddenly companies are into financing and they are not taken certificate of registration and they are not maintaining the net own funds. Very simple, guys. Don't elongate answer as they have done. It is not required. Simply say that your exception report. Okay. Simply talk about the exception report. We are going to discuss about exception report soon. No need to rectify all these things here. You talk about exception report, you talk about Caro also. That is more than sufficient. Now, what are the different types of NBFCs registered with RBI? What are different types of NBFCs which are registered with RBI? Okay. So you can simply give the list. Now, guys, there are a lot of different types of entities are there. Different types of NBFCs are there which are there in the finance business directly or indirectly. Majority of them need to get registered with RBI, but some of them are not registered with RBI because they're already registered with other regulators. For example, some of them like venture capitalists, they are supposed to be registered with SEBI. Some of them like insurance companies, they are supposed to be registered with the insurance IRDA. So you can say that there's a big domain. There are different types of NBFCs. Majority of them need to get registered with RBI. Some of them need to get registered with SEBI. Some of them need to get registered with IRDA. and some of them they don't need any kind of registration. Anyways, we are focusing on those NBFCs which generally need registration. Some time back, there was an amendment. They said that asset finance companies were major businesses to finance any kind of asset like trucks or cranes, then loan companies, then investment company, they are merged into investment and credit company. So if we talk today, what are the major type of NBF, what are the major type of NBFCs, major type of NBFCs which are registered with RBI, IFI, Indian Film Festival, International, okay. So IFI is a film festival, IFI inaugurated by CM. So at IFI, we will come to know what are the NBFCs registered with RBI. I stand for investment credit companies. Investment and credit companies, they need to get themselves registered with RBI. Non-operative financial holding company. Okay. Now what RBI has done, if anyone wants to have a banking license, they need to make a non-operative financial holding company, and all the money will come to non-operative finance holding company, bank. Then, so if anyone wants to have a banking license, they have to make non-operative financial holding company. This particular company, so all the money will come here, and this will have subsidiaries. One subsidiary is into banking, one subsidiary is into securities, acting as a broker, one is into insurance, one is into housing finance, and so on. So banks, RBI wants a very streamlined structure. It wants a main financial holding companies, and from there multiple subsidiaries should be created doing different type of work. So RBI wants for banking license non-operative financial holding company as a main holding company under which all the different subsidiaries and businesses will come. Even that needs to get registered with RBI. So F stand for financial holding company, F stand for factoring. So those NBFCs which buy debtors, they are called factoring company. Then those are into infrastructure finance company, IFC. Along with that, infrastructure debt fund, infrastructure finance company, they are very big companies. They're focusing on infrastructure financing. Debt funds created to finance a particular infrastructure project or a class of infrastructure projects, that's called infrastructure debt fund. Okay. CM, core investment company, which is for financing a particular business group. And finally, microfinance company is focusing on very small level of financing. Very small, micro as named, a very small level of financing ranging from 50,000 to 1 lakh rupees. They are unsecured to marginalized portion, area of our society. Those who cannot afford to go and get loan from the banks and other NBFCs, for them, we have microfinance institutions. So, in short, these are the NBFCs which generally give list of the NBFCs which are generally registered with RBI. At IFI, CM will tell us, simple, at IFI, CM will tell us what NBFCs need to get registered with RBI. Okay. So investment and credit company, financial holding company, factors and NBFC factors, infrastructure finance company, infrastructure debt fund, core investment company, microfinance company. Guys, you have to remember broadly, okay, these are the guys which need to be registered. Then this is May 23 RTP question, guys. There can be new activity-based classification. Activity-based classification. So, very interesting, very important. There is a base layer, there is a middle layer, there is a upper layer. There is a new. All the NBFCs are now categorized into new categories. Okay. Government owned NBFCs, let's see guys, there can be MCQs, lot of important things. So a new kind of classification has come up. New kind of classification has come up. Let's understand this. So RBI has come up with a new kind of classification, and the classification is pretty simple. RBI has created 4 layers. At the bottom we have base layer, above that we have middle layer, above that we have upper layer, and above that we have top layer. Base, medium, upper and top layer. Okay. Top layer is generally expected to be empty, but in certain situations, some NBFCs will be introduced in the top layer also. Let's understand. Let's understand who will go. So if you need to explain that there are 4 layers. There are 4 layers. And you need to explain. This is a very good shortcut. This is a very good shortcut. First, you need to explain that. First, you need to explain that in base layer, who is going to come? All the NBFCs which are not accepting deposits. If someone are not accepting deposits, it is less sensitive, less crucial, because public money is not involved. So if there's an NBFC not accepting deposits, it is financed by their shareholders and big banks or financial institution. They are not accepting deposits. Asset size. So these guys are not accepting any kind of deposit. Asset size is not exceeding 1,000. They will go in 1,000 crore of assets, not exceeding 1,000 crore. They will go in the smallest layer, base layer. Then some of these will always go in base layer. Always go in the base layer. PAN NBFCs will always go in base layer. P stand for peer-to-peer lending. If one person wants to lend to another and there's an intermediary, that's called peer-to-peer. NBFC which are facilitating peer-to-peer they will always go in the base layer. Then A stand for account aggregators. Account aggregators. So if you are multiple banks, and if the company comes and say that I will provide you app, I will aggregate all the accounts, all mutual fund and every credit card, debit card into one single app and make your life easy. They are simply acting as a facilitator, nothing. They are not doing real finance. They are simply aggregating everything at one place. They go to base layer. Then non-operating, financial non-operating holding. I just explained that in today's day, if we want banking license, we'll have to open non-operating holding, financial non-operating holding company. Then any which is not availing public funds. You are not raising public funds, okay, and you are not directly connected to customers. You don't directly communicate with customers, okay. You are just an intermediary. Then again you will fall in base layer. So peer-to-peer entities, account aggregators, non-operating financial holding company, not availing public funds, okay, these two, and they will always go in base layer. What goes in middle layer? If you are taking deposit, you go to middle layer. You go to middle layer. Or you are not taking deposit, but asset size has crossed 1,000 crore. You go to middle layer. Guys, there can be case study on this. There can be MCQ on this. Then Shakal is coming, hide immediately. That's a shortcut. Or Saichi is a shortcut. Standalone primary dealers. So those who deal into government bonds. I for infrastructure debt funds. Always in middle layer. Then Chi, core investment company, housing finance company or infrastructure company. It may go to middle layer, it may go to upper layer also. Either it will be in the middle layer, that is the most preferred, or it may go to upper layer if criteria is fulfilled. So Sai will always be in middle, standalone and infrastructure debt fund. Chi will depend. It can be middle, it can be upper. Now what goes into upper? Top 10 NBFCs as per asset size, always upper. So if the key companies, core investment company, housing finance company, infrastructure company, if they're into top 10, they will always go in upper layer. RBI has set more criteria for it. Now top layer, upper layer, top layer is ideally empty, but if there's substantial increase in potential systematic risk of upper layer NBFC, if there's an upper layer NBFC and it has become very risky, it can have effect on the whole market. It can have a damaging effect on the whole market. It has become very risky. Any very big NBFC, it will be categorized to top layer. So upper layer entity which is very risky will go to top layer. Government owned NBFC shall be placed either in the base or middle. They generally don't go to upper layer and top layer. Government owned NBFCs, this can be targeted in the case studies and MCQs also. Government owned NBFC will not go to the upper layer or top layer. So basically RBI needs to focus more on these entities. That's why there is a separate layer of upper and top. NBFC not taking deposits, okay, they generally I'm saying generally they go for the base layer. NBFC taking deposits or big, not taking deposit but big, they may go to middle and upper layers. We have seen if asset size not exceeding 1000 crore, they may go to base layer also. This is not very important, guys. This is not very important. So RBI said initially these such things may happen. So the most important are the 4 layers and the criteria for the 4 layers, and whatever is in the chart, that is the most important thing. You're supposed to focus on that. Very, 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 very important. Extremely important, guys. Then there's a housing finance company. Sugam Housing Finance Limited is in business of housing finance activity having asset size of 800 crores. Asset size of 800 crores, guys. Asset size of 800 crores. Its principal business is of providing finances for housing mainly to individuals. It is not identified by RBI in upper layer. It is not upper layer, okay. Under scale based regulation introduced by RBI, what should be appropriate classification? What should be the appropriate classification for such companies? Okay, for such companies, it will not come in PAN, it will come in SAICHI. It will not come in PAN, it will come in SAICHI. It may go to base, it may go to the middle layer. So it may go to middle layer, upper layer. They are saying that it is not going to upper layer. So it has to go to middle layer. Guys, as I have been saying, you are going to get cases where you need to predict whether it's a base layer, whether it's a middle layer, whether it is the upper layer, whether it is a top layer. That is going to be very famous question in the upcoming exams. Okay, and they're very easy. Just go through all of them. And I have covered that in the previous question. Any specific reporting requirement under CARO 2020 for statutory out of company engaged in housing finance? So first you need to explain the criteria. For middle layer, that accepting deposits or not accepting 1000, then SAICHI. Then you need to explain that housing finance may go into the middle or upper layer. As it is not upper layer, it will go to middle layer. First explain that. First talk about the middle layer. First you talk about the middle layer and then you talk about the CARO. So there is a CARO clause number, certificate of registration, clause number 16, and we have to comment in CARO clause number 16. First we need to comment about certificate of registration. If it's an NBFC, if a company is an NBFC, whether they have taken proper certificate of registration. They need to comment whether they have performed any financing activity or housing finance activity without certificate of registration. Okay. And then we have to say that if it's a core investment company, we need to tell whether they fulfill the requirement of core investment company, whether they fulfill the requirement to remain unregistered in the core investment company, and whether there are multiple core investment companies. So you say yes, there is a requirement. We need to tell whether any housing financing activity is done without any certificate of registration. So we need to simply explain the clause of the CARO. So the two things they are focusing on, it's a middle layer, and then we need to focus on the CARO thing. Registrations and regulations of NBFC. Again, we are back to registration. It is a study material question, guys, so it is very important. I am saying that whatever is targeted in study material will be asked. They are just going to twist the questions. Start the audit of NBFC. They have not performed much work for the NBFC in the past years. You are required to explain requirement to registration and regulation of NBFCs, which an auditor needs to keep in mind while planning the audit of NBFCs. Okay. So first they are talking about who needs to get registered. Then they are talking about the process. Then they are talking about dual regulation. Then they are talking about RBI circulars and norms. Let's see, guys. So they are asking us registrations and regulations. So say RBI regulations overview. So I think first you should talk about that. NBFCs need to get registered. So first check if it's the NBFC, nature of transaction, 50-50 rule. If it's the NBFC, they need to get registered. They need certificate of registration from RBI. They should maintain the net own funds of 2 crores. Depending on nature of the NBFC, this requirement can increase. This requirement can be more. Explain who. The process is very simple. So as per RBI Act, you always give reference of RBI Act and Banking Regulation Act. You can apply, if you are in category of NBFC, you can apply for the registration, you can apply for certificate of registration. Then certain classes of NBFCs are regulated by other regulators, so they don't need to get with RBI. Okay. For example, Nidhi companies don't need to get registered with, for example, they are broking companies, fund merchants, venture capital with SEBI, some of them with IRDA, some of them with the MCA, Companies Act, some of them are with the Chit Fund Act. So many of them don't need to get registered with RBI. So you explain that. Then RBI regulations are there. RBI regulations are with respect to how to take deposits, after accepting deposits, then how to maintain the capital, what kind of advances should be given, how much capital adequacy ratio should be maintained, how NPA classification should be done, how income recognition. Simply imagine the NBFC business. They first accept the deposit. There are regulations for that. Then they have share capital. They have share capital. The regulations for that, capital adequacy ratio. About the deposit, there are regulations. Then about investment, there are regulations. About loan, there are regulations. Then about NPA classification, there is regulation. Then provision for NPA, income recognition. So there are regulation for a lot of aspects. So you can simply say that first explain who are supposed to get registered, then explain who are not supposed to get registered. It's very simple application. We go and apply. You talk about RBI regulations are for different aspects. So again, November 23 mock, systematically important. Now guys, what is systematically important? Any NBFC which is very huge in size, which is very huge in size, which is very big in size, very big in size as per the assets, as per the asset. Just a minute, guys. Very big in size, generally exceeding 500 crores. It is considered systematically important. Operating revenue has started decreasing, falling where the position net own funds 15 crores, then 6 crores, then 4 crores, then 1.5 crores. Mr. Sham identified that net own funds have been less than 2 crores since 2022. Kindly guide Mr. Sham with respect to his reporting requirement as per relevant provisions of RBI. Now, let's understand this, guys. So, it is an NBFC, need to get registered with RBI, and they need to maintain their net own funds. And the minimum net own funds required is 2 crore rupees. They are clearly going below net own funds. So, a very important legal requirement is getting breached. And this definitely need to be reported to RBI. This definitely need to be reported to RBI. So net own funds requirement 2 crore, they are explaining that. Then they will lose the eligibility to hold certificate of registration if the net own fund requirement is not there. A certificate from statutory auditor in this regard with reference to position of the company at the end of the financial year is supposed to be submitted to regional office of Department of NBFC supervision within 1 month from the date of finalization of balance sheet, which should not go not later than December 30th in the format, and in a particular format it should be done. Requirement. So first, need to explain, it is an NBFC and they are supposed to maintain net own funds. Minimum 200 crores the requirement is a very important criteria. If not, there will be severe implications. They will not be able to hold certificate of registration. The requirement is that as soon as the financial statements are finalized, they are there within 1 month. Statutory auditor, as per the audited latest audited financial statement, within 1 month is supposed to issue a certificate to regional supposed to issue a certificate on net own funds within 1 month from the date of financial balance sheet, not later than 30th of December. Are these guys maintaining net own funds? Are they eligible to hold? Are they eligible to hold certificate of registration? So here reporting will be done that they are not maintaining net own funds. They have lost their eligibility to hold certificate of registration. Simply explain about net own funds. Then you explain that after finalization within 1 month, report, give a certificate to RBI. Are they maintaining minimum net own funds? You say they are not and they have lost their eligibility. So here we'll have to report that you have lost the eligibility. They have lost the eligibility. It's very simple, straightforward, guys. It may appear a very big case, but then it may appear a very big case, but it is not. It is not that a big case. Now, prudential norms. Prudential norms. It's very important. It's very important. It is very important that NBFCs, okay, NBFCs are prudent. They are prudent in their. They are prudent in their accounting, in their classification, in their accounting, in their approach. They should be financially sound, they should be financially strong, financially sound and financially strong. That's why there are prudential norms. Okay, so let me tell you about these prudential norm, guys. Okay, guys. So RBI has issued prudential norms that be conservative, be conservative. The prudential norms is a requirement. There is a capital requirement. There is a requirement for income recognition. There is a requirement for non-performing assets. Let's understand this. So in prudential norms, the most important requirement is with respect to capital. All the NBFCs are supposed to maintain enough capital, decent capital, so that they can absorb the losses. If losses arise, they are able to absorb the losses, and losses are not borne by the deposit holders and the lenders. Okay, so they are supposed to maintain. So all the big entities, NBFC deposits and NBFC NDSI means systematically important. All the big NBFCs, they are supposed to maintain. Guys, listen, whatever I'm saying, just try to understand and catch hold of that thing. Don't try to think, oh, so many things are there. Focus on these things, guys. Let me tell you, they are not going to ask anything from RBI, from the RBI website. They are not going to ask anything from, they are going to ask somewhere from here only. The question and the concept they are focusing on, there's a 99% probability that these things only will be targeted. So you will explain that there's a capital requirement for big and those NBFC taking deposits and NBFC systematically important. They are supposed to maintain capital adequacy ratio, capital to risk weighted asset ratio, that's the same. At least 15% should be maintained. At least 15% should be maintained. Tier 1 capital. Tier 1 capital is very high quality capital, which can absorb losses very easily. That is pure your share capital, your reserves, that comes there in tier 1. And tier 1 capital should contribute at least 10% out of 15%, should contribute at least 10%. And then we have tier 2 capital. Okay, in tier 2 capital, then the remaining 5% can be tier 2 capital. It's very simple. So first explain the requirement with respect to capital, that is capital adequacy ratio, minimum 15%. In case of banks, it is on the lower side. In case of NBFC, it's on the higher side. In case of banks, it is up to 9% it is required. NBFC, it is required 15%, and that too, tier 1 should account for 10%. So the capital requirement for NBFC is on the higher side. If it is a gold loan company, then the tier 1 requirement goes to 12%. So you explain prudential norms. The first requirement is with respect to capital. Then income recognition, very simple, that you should book income on the accrual basis. But if any account becomes NPA, you reverse the accrued income and shift to the cash basis. Okay. So you first talk about the capital. The next important thing you talk about is income. The next important thing is about NPA. And the next important thing is you talk about NPA. Guys, one more thing. The 3-month criteria is there. If you look at the module, you will say, oh, it is, sir, it is not 3 months, it is more than that, it is 6 months or more than that. If you read carefully module, at the end they have specified that terms have changed. Now it is 3 months. And in prudential norms, they have specified that NPA norms are there. Term loan become NPA if amount is overdue more than 3 months. Short-term loans, if again things become overdue more than 9 months. Same is with bill purchase. Demand loan, from the date of call, if amount is not paid within 3 months. Same with the lease, and it should be borrower wise. So NPA norms, and it talks about standard assets. If there's a default, it goes to NPA. First category is substandard. After 1 year, it will go to doubtful. In doubtful, there is a there's a 12-month. There's doubtful for 1 year, 1 to 3 years, and more than 3 years. And if, as per internal and external, if there are factors such that which clearly shows that recovery is very difficult, it is called loss asset. So, guys, when it comes to prudential norms, you talk about capital requirement, you talk about income requirement, you talk about NPA requirements, and asset classification. Okay. So, if you write about these things, guys, that will be more than sufficient. So, guys, they are talking about similar things. They are talking about similar things, guys. Then the next is asked in May 22 mock, November 22 mock. What are the general audit procedures when you go to audit of any NBFC, irrespective of what is the nature of the NBFC? What are the general things you go and check? Mandatorily become part of audit procedures, conducting the audit of. So you can say these are the mandatory audit procedures. These are general audit procedures applicable to all the NBFCs. They are mandatory audit procedures. Okay, let's see, guys. It's pretty simple. First, we need to focus on the business. First thing is we need to understand the business. Go and read MOA, what is their business? Understand their business policy, in which sector, in what sector they are going on. Understand their decisions. From MOA, you will get what is the type of business. From business policy, you will understand what kind of financing they are into. For their decisions, you will understand what kind of financing they are into. Independently from market, try to understand what they're. First, go and try to understand their business. First, the most important MOA, AOA, then their business policies, then their minutes, then independent corroboration. Then go and understand internal controls. You say that it is management responsibility to establish it, and it should be sound internal control system. Auditor should go and understand how good are the internal control system. Are they operating effectively? It should be tested. First focus, general audit procedure is first focus on try to understand the business, then try to understand the internal control system, how they are doing. Then next is the most important thing. Are they carefully accepting deposits? Are they carefully accepting deposit? Try to understand first, as per board resolution, are they eligible to accept deposits or not? Some of them say that they won't accept deposits. Some of them say that they will accept deposit. First, board resolution, are they eligible to accept deposit? If yes, what is, as per credit rating agencies, what is the maximum limit? As per that, their deposit taking capacity is determined, limit is determined. What is credit rating? Then, see, it's in a sequence, so that they will get the limit. After getting limit, they should get standard forms, written application for deposits. Once deposit accepted, deposit register should be maintained. Always liquidity is maintained so that anytime you have to pay them back, it is easy to pay them back. There should be, after that, regularly interest should be calculated and paid to them as per the terms and conditions. On annual basis, return should be filed to RBI that what they are doing with the deposits. Are they handling deposits properly? And then submission of accounts on regular basis. Accounts, audit report, director report need to be submitted to RBI. Accounts, audit report, and director's report. So, guys, if we say that these are the general audit procedures, and before that we have registration with RBI. Let's freeze. What are general audit procedures? The most important thing, whether proper registration, certificate of registration taken from RBI. Then you go and understand the business. Then you talk about internal control systems. Then you talk about internal control systems. Then you talk about the deposits. See, guys, up to here, these first few things. So business they are covering, internal control systems they are covering, registration with RBI they are covering, they are talking about prudential norms, They are talking about NBFC classification. So that's the issue, guys. Many times the points may not match exactly. Don't worry about it. So I will say that you talk about RBI, you talk about certificate of registration, you talk about certificate of registration, then you talk about the business, then you talk about the internal control systems. Internal control systems, they are not focusing on deposits because some NBFCs may accept deposits, some NBFC may not accept deposits. Then they are talking about the brief overview of the prudential norms. There's a capital requirement, there's an income requirement, there is a classification requirement. You talk about them, investment requirement. Okay. So these are the general audit procedure. This should be included everywhere. Deposit mobilization in NBFC. November 20 exam, it was first, then May 22 RTP, then May 23 MTP. It is there. Is conducting statutory audit. The company with a focus on housing finance has non-convertible debentures worth 150 crores. Debentures they have taken. Missed interest payment of 15 crores. There is an inadequate liquidity. There is a series of downgrades by rating agencies. From cut to D, from A4 to D. There was A category rating, it has come to D. What aspects he and others should look into relation to the activity of mobilization of public deposits, particularly downgrading the credit facility, guys. They are specifically talking about one aspect only. Now, guys, let me tell you, just when it comes to deposits, this step-by-step thing about board resolution, then credit rating limit, okay, then return applications, deposit register, liquid investment, interest calculations, filing returns, and so on. So these are the requirement when you accept deposits. There are NBFC public deposit directions, and these need to be followed by a NBFC company with respect to deposit. Okay. Now they are saying that focus on one thing only. What has happened? So first you need to explain that the limit of deposit depends on credit limit, on credit rating. How much deposit an NBFC can accept depends on the credit rating, importance of credit rating. Higher is the credit rating, more deposit you can accept. Lower is the credit rating, less deposits you can accept. Now here, the financial condition is deteriorating. Financial condition is deteriorating and credit rating is going down. So their ability to accept deposit reduces drastically. So they will have to, what they will have to do in such case, stop accepting fresh deposits. Okay, short accepting fresh deposits. All existing deposits shall run off to maturity. Stop, don't accept the fresh deposits. You have to reduce the deposit levels. C, you have to reduce in public according with the revised credit rating agencies, credit rating limits. So if the credit rating goes down, you need to reduce the level of deposits. You'll have to repay certain deposits. So whatever deposits are getting matured, repay them, don't renew them. Stop accepting deposits. Whatever, don't renew the existing deposits. Try to pay off the deposits which are going to mature soon. Try to pay them off and bring it to the acceptable limit. Tell to regional office what the situation. Again, no renewal. So first you need to explain the concept of credit rating, that depending on information, there are a lot of credit rating agencies, CRISIL, ICRA, CARE, they do credit rating, and depending on credit rating, RBI decides what should be the limit of deposit you should be accepting. You explain that concept. And if it is rating is going down, limit will go down. You need to bring the deposits within the limit. How you do that? You don't accept the fresh ones. You don't renew the matured deposits. You ensure that the deposits which are going to mature soon, they are paid off early. properly paid off and communicated, you bring it within the particular limit. That is how you bring things under control. Okay. So guys, we have covered a lot of questions, but still some questions are left. Some questions are left. We will try to do this in the next lecture, guys. We'll finish off NBFC. In next lecture, we'll finish off NBFC also. In next lecture, we'll finish off PSU also. We'll try to finish off PSU, and we'll try to finish off the chapter number 16 also. So next lecture, we are going to finish off a lot of things. Okay. Guys, if you like it, do share it and do put your lovely comments. They matter a lot to us.